Well, good morning and welcome to the 7th and final edition of the Pinnacle 2020 Virtual Summit. I'm Matt Dell. Our topic today is fixed income. Volatile market conditions and record low interest rates have prompted many investors to rethink their fixed income allocations in order to achieve their income goals, but also to protect their capital in what is traditionally a defensive part of an investor's portfolio. Today, we have two speakers, each operating in the fixed income markets, but with completely different approaches. Metrics' Andrew Lockhart and Coolabah's Christopher Joye and Ying and Cheng. Each of them will share their insights and outlook for about 25 minutes each. Then our moderator for today, Lonsec's Ron Mehmet, will host a Q&A session in a panel format. Okay, before I introduce our portfolio managers, a couple of quick housekeeping items to ensure you get the most out of today's session. Our digital summit webinar platform is fully customisable. You'll see a bunch of icons at the bottom of your screen, which will enable you to access further information, such as download presentations, access CPD hours via Portfolio Construction Forum, and of course, ask questions. You can also access further information on the great community work of the Pinnacle Charitable Foundation. We're excited to announce today that any donations we receive during the summit will be doubled by Pinnacle, up to a total of $10,000. Okay, so let's begin. Our first speakers are Christopher Joye, the co-founder and Chief Investment Officer of Coolabah Capital Investments, and Ying and Cheng, Portfolio Management Director at Coolabah. Coolabah is an active manager of fixed income securities. What makes Coolabah different is that rather than taking on high levels of risk in order to maintain income yields for investors, Chris's team of 23 executives actively trades highly liquid investment-grade securities to realise capital gains. The success rate in generating capital gains for investors is over 86%. Chris and Yingers, welcome to the summit.
So, thanks, Matt. And basically today, topic that we want to discuss is the existential investor choice. Does one add value or do we add risk? I want to frame today's discussion around this key problem. With the RBA's cash rate at 0.13% and the average term deposit rate at 0.65%, where do investors find safe and liquid income that is going to beat a 2% inflation rate by a decent margin? What you see in front of you are various investments. And on the left-hand side, you can see these various investments ranked by their yield or their interest rates. And in fixed income, the best distillation of risk is yield. On the right-hand side, we have summarised the key risks of these investments, including their credit rating, their liquidity, their interest rate risk, their credit risk, and the risk of mark-to-market loss. Chris, can you elaborate on this?
Yeah, Ying, I think that what's interesting on this slide is, as you point out, the three biggest risks in fixed income are liquidity risk, firstly. So that's the ability or the inability to buy and sell assets in stress scenarios. So in March, we saw huge illiquidity in fixed income. We bought and sold over $1 billion of assets, but they were mainly senior bonds and hybrids. We saw a lot of illiquidity in corporate bonds and also in deeply subordinated RMBS and ABS. The second big risk is interest rate risk. So if you buy a fixed rate bond with a 10-year term, and if interest rates go up, you've locked in your rate. And so the value of your bond will fall. Conversely, if you had a floating rate bond, its price would not be affected, and rather its yield would rise or fall. The final big risk is credit risk. So this is a risk of basically a bond going into default and recovering less than 100 cents in the dollar. So we saw this in November. Virgin listed a senior unsecured bond on the ASX, and this was a consistently unprofitable and highly levered business. We didn't invest because in any stress scenario, it was always going to perform badly. And we saw that Virgin defaulted, and now investors are only going to get about 5 to 10 cents in the dollar. And on the chart, you can see that a 10-year government bond is government guaranteed, It's very highly rated. But because it has a lot of interest rate duration risk, you can actually get quite big monthly losses. And not everybody can stick around for repayment in 10 years' time. You can also see that on a AAA rated RMBS security that's issued by a non-bank, you can get an attractive 2.9% yield. But this has very poor liquidity. So if you're forced to sell, you could have a big loss. And then finally, you can get good returns in high yield bonds. And they have high default risks, but they can also have high liquidity and duration risks. And again, that can give rise to really big losses that can be consistent with the downside risk in equities.
So how do you decide when given the choice between a BB plus rated regional bank hybrid yielding 3.5% per annum or a AA rated non-bank below prime RMBS yielding 3.6% per annum, or Woolworths shares with the same dividend yield, or B-rated global high yield bonds yielding 5.7% per annum, or even CBA shares with a 6.5% dividend yield? Chris?
Yeah, Ying, I think they're good case studies. So you can see that non-bank RMBS is very highly rated. It's got a AA rating, the same as CBA. But it pays you the same yield as a regional bank hybrid. And that's for a reason, because there's embedded risk. And also a similar yield to Woolworths equities. Conversely, you can get high yields from junk bonds or high yield bonds with high default risks and risks of low recovery rates when they go into default. But you can get actually better returns on CBA equities. Yet they also come with very high risk of loss.
So do investors understand the risk? And what you see in front of you are the maximum monthly capital losses and the maximum monthly capital gains since 2016 for a variety of investments, including term deposits, senior bank bonds, government bonds, bank hybrids, subordinated bank bonds, global high yield, listed RMBS funds, Aussie equities, and listed high yield bond funds. Chris, can you talk us through what we see on this slide?
Yeah, Ying, is again, highly rated subordinated RMBS listed on the ASX that many folks probably thought was very safe, actually suffered a 17% loss in March. Similarly, those high yield bond LITs that many folks thought would trade consistently around their net asset value, and which folks thought would be as safe, if not safer, than equity LITs, actually had 25% losses. That was, in fact, worse than the share market, which fell 22%. I think it's interesting, the hybrid market only suffered a 6% loss. And in our active ETF product, HBRD, which is a listed portfolio that invests in hybrids, we did somewhat better. So in March, that only fell 4.5% net of fees, outperforming the wider hybrid market. But hybrids substantially outperformed bank equities, which were down 25 to 35%. You also see here that AAA rated government bonds, which, all things being equal, are meant to be risk-free. If they've got duration risk, they've suffered losses as much as 2.4% in a given month when interest rates have risen. So that's actually higher than the losses we've seen on floating senior bank bonds.
So let's discuss these two choices. Do investors add value or add risk?
Yeah, so I think adding value, which is what we try and do, is much harder. It involves trying to identify mispriced bonds that will appreciate, that will give capital gains or alpha as their prices move back to fair value. We want to focus on very safe bonds that are tradable or liquid, and bonds that don't have much endogenous or internal credit or default risk. We don't want securities that will become illiquid or go into default in a stress event. Adding risk is really just about chasing yield. It's extremely easy to do. And that means identifying assets or bonds with high yields. You buy and hold, and you really hope nothing goes wrong. And those yields are a pure risk trade-off. So they mean you're either taking more default risk, more liquidity risk, or more interest rate risk.
So this chart is a visual representation of what Chris just spoke about. So what is fairly easy to deliver in order to drive more return involves adding interest rate duration risk, which involves, investing in longer dated fixed rate bonds, or it could mean, higher credit risk or adding more credit risk, i.e. investing in high yield bonds or loans or securities that are rated BB, B or CCC, or even unrated instruments. It could also involve adding illiquidity risk, i.e. illiquid loans, illiquid corporate bonds, and illiquid ABS and RMBS. What is harder to deliver but allows us to generate high returns from low yielding assets is finding capital gains, alpha, and that's through identifying mispriced bonds and trading. And adding value means that you don't blindly diversify.
Yeah, I think, Ying, this is a good point. In fixed income, there's a working belief that diversification is a universally good thing. And you often see portfolios with 200, 500 or 1,000 bonds. The problem is that those portfolios often load up on a lot of correlated risk. So we mean correlated default and or correlated liquidity and interest rate risk. And we saw this in March where a lot of portfolios froze. They became very illiquid because they couldn't find a bid for the assets they were holding. And they tended to be assets that are very cyclical, assets that perform badly in recessions. So things like airlines, retailers, and bonds issued by commercial property owners, residential developers, shopping centres, and non-bank lenders that finance riskier borrowers. And I think this is what explains the illiquidity in March. It wasn't that you couldn't trade. It's that in March, nobody wanted to buy those illiquid or higher credit risk securities. So again, we had no issue with liquidity in March. We bought and sold over $1 billion in that March, but focusing on liquid senior bonds that are repo eligible with the RBA, and also, interestingly, liquid hybrids. One of the features of the hybrid market was we saw daily turnover north of 120 million a day. That means we were seeing on the ASX more than 530 mil trade every 7 rolling days. And HBAD, our active ETF, I think it was, Ying, is the only fixed income ETF or LIT in the world that didn't trade at a big discount to its net asset value. And we saw this everywhere. ETFs and LITs trading at massive discounts in price terms to their NAV.
And to exemplify this, on the right-hand side, you can see the difference between the AusBond floating rate note index's ETF that replicates this, and you can see the price versus the NAV. In the blue line, you can see the NAV or the net asset value, and in the white line is the price. So even though the index has an average credit rating of AA, it also contains many illiquid assets, including Chinese banks, Middle Eastern banks, etc. And you can see the ETF NAV was actually quite stale and illiquid, and the white line, which is the price, is probably right.
Yeah, Ying is, you can see that blue line. It hardly moved, whereas the price was likely reflecting what buyers and sellers really thought about the value of those assets.
So Chris, can you explain why we did have this disconnect between the price versus the NAV in 2020?
Yeah, well, I think we can refer to experts here, like the Bank of England or the central banks, two banks known as the BIS or Invesco. And they all found the same thing, which was that the price of LICs and LITs or ETFs was a much better representation of true value. And the NAVs were stale. They weren't being updated properly. In fact, Invesco said that it thought that fixed income NAVs in March were basically meaningless, and the real representation of value was in the price. And the Bank of England and the BIS found similar things.
So to really add value requires large team and world-class technology. Chris, can you explain how we're doing this at Coolabah?
Yeah, so as you said, Ying, it's not easy trading actively, revaluing every bond in the world every minute of the day, and trying to hunt out those mispricings. For us to do it, we need 24 full-time execs. So that includes 12 analysts and 5 portfolio managers. And those very smart guys, much smarter than me, have 4 PhDs and 2 of them have university medals. And I think that if you don't have a team of that size in Aussie credit or global credit, then you have no choice but to just diversify and chase yield. So again, I just stress that in fixed income, credit ratings can be highly illusory, and the best risk benchmarking is going to be yield. All roads lead to yield as a true representation of risk.
And again, adding value, as you said, requires very active trading. Can you walk us through what we're seeing here?
Yeah, so this is a screenshot from our systems, and it shows that in January, we gross sold 1.14 billion of bonds, months before COVID hit. And then in March this year, the big red bar shows you that we bought almost 900 million in that month and sold about 100 million. So in the year to date, this is a little dated, but we've bought and sold over $14 billion of credit. And that has involved over 12,000 buys and sells. So my team is typically trading about 70 times a day on the ASX and in the unlisted OTC market. And we're typically executing about 80 million a day to hunt out for those mispricings.
And again, adding value requires proven alpha generation. Chris, can you walk us through this?
Yes. So this is a screenshot from our systems, and every black dot is a bond sale. These are all the bonds we've ever sold. It's quite a few. Right now, it's more than 15,000 sales. And on the vertical axis is the actual return we've captured. And what you can sort of see there is that when we measure what share of the time do we make money, it's about 98%. So we have a 98% win ratio across these 15,000 plus transactions. And we're generating capital gains about 88% of the time. And I think that's probably borne out in our rankings as well. So in FE Fund Info's Cash Enhanced Universe, we have a product, Smarter Money Higher Income, that is ranked number 1 net of fees over 1, 2, 3, 4, and 5 years. Pre-fees, our long-short credit fund, is also number 1 in Mercer's short duration credit universe over 1, 2, and 3 years. We also have a long duration product that pre-fees is number 1 or 2 in Mercer's Aussie fixed income universe over the last 3 years.
And we've prepared some attribution analysis with respect to returns over 2020. Chris, can you explain this?
Yeah, it's a bit hard to see, but basically these are our 4 key products. And the bottom row really shows you the proportion of our total return that is driven not by yield, not by risk, but by that capital gain or mispricing-led alpha. And I can actually just make out myself that about 53% to 70% of our total returns before fees this year, this is from 1 January through to end August, have been made up by capital gain. So in a low yielding world like the one we face today, where the likelihood is that yields will be low for long, you again really have 2 choices. You chase risk and therefore try and drive yield in that search for risk, or you work very, very hard and try and add value, not add risk, through active management, through active trading, through revaluing every liquid and low credit risk security globally, looking for those mispricings. To do that, we've had to build more than 30 internal quantitative bond valuation models to allow us to hunt out those mispricings units.
And that's the key message for today. The existential investor choice. In a low yielding world, Do you add risk or do you add value?
Well, thanks, Chris and Yingers. And remember that you can continue to ask questions and that Ron Mehmet from Lonsec will be moderating Q&A after our next presenter. Before I introduce Metrics, we're going to take a quick 30-second break. Stand by. Well, welcome back. Our next speaker is Andrew Lockhart, the Managing Partner of Metrics Credit Partners. Andrew has more than 30 years' experience in banking, funds management and financial markets. He's previously specialised in leverage and acquisition finance, as well as corporate and institutional lending. Metrics is now the largest non-bank lender to corporate Australia, and retail investors can now access private debt through both listed and unlisted vehicles, where previously its availability had been limited to institutional investors only. Andrew, welcome to the program.
Thanks, Matt, and welcome everyone. For those of you that were listening to the prior session, obviously we've heard the presentation talk to the fact that to generate income or return, investors are looking to take on more risk. I think one of the things we would like to do is obviously challenge that assumption as in our presentation today. I guess in terms of the world of fixed income, you know, we operate in private markets. Metrics Credit Partners is a business that was established in June of 2013. We are a team of around about 60 people with a presence in Sydney, Melbourne and in Auckland in New Zealand. We operate a range of different funds that are designed to provide investors with a choice, be it in terms of the risk expectation that an investor is prepared to take, the returns that can be generated from our asset class, and we've created a range of different attractive investment products and options for investors where they can determine the extent of their requirements around liquidity, from trading on the ASX in, say, the MCP Master Income Trust and the MCP Income Opportunities Trust, or investing in some of our underlying wholesale funds that are unlisted. The team, we operate currently a bit over $5 billion in total assets under management. And as a team, we've completed well in excess of 10 billion of transactions that we've completed, over 350 individual transactions. And I think the key to it in terms of our activities is very much the direct origination that we bring to investors. We often say that we're looking to bring investors closer to the point of origination, and that is really designed to capture better economics and better means to manage risk. We believe that the market that we operate in is an attractive market. It's very much a bank-dominated market, and so obviously people have experience investing in sort of public market securities, often bank bonds, where banks are raising debt financing and using those proceeds to on-lend to companies. Our presence and activity in the market is designed to provide investors with direct exposure through to the underlying borrowers that the banks would otherwise finance. And it's really a risk continuum. And so our market, obviously there are high investment grade Australian companies, and we invest in those, and we lend to Australian publicly listed investment grade credits. We also provide financing to sub-investment grade borrowers. But equally, our activities also span through the entire capital structure. So from senior unsecured debt, senior secured debt, mezzanine or subordinated debt, through to preference equity and equity-like activities, depending on the nature of the fund and the mandate that we have with our investors. I guess as a team, the team is, again, as I say, very focused on the first activity there is origination. And what that means is, as a team, we have a range of people within our business that are responsible for going and building good long-term relationships with Australian companies, seeking to find opportunities to lend to these companies. And so that requires a deep network of relationships with banks, with borrowers, with corporate advisors and others to be able to find those opportunities to lend. And we do that as a means to generate better returns for our investors. If you think about it, if you originate the transaction and you're charging a borrower a fee, the fee income becomes revenue and income to our investors. Often, if you're a passive manager or you're dealing in public market securities, you'll be reliant on others to bring a transaction to you. And so a lot of funds management groups that deal in public market securities, for instance, have never brought a company to an IPO in an equity raising, or never structured the terms and conditions associated with investing in a bond. Often that's been done by others. Our team, the others that actually do that. And part of that process is to ensure that we can negotiate the right fee for the risk and deliver a better return for our investors. And that process is actually where the economics in a transaction often get stripped, and investors don't receive the benefit of that origination activity if a manager or an investor is more passive. And by that I mean when we go and provide financing to a company, say we're providing financing and we're charging a fee, say that fee is 200 basis points. That fee then becomes income to our investors. If we had been passively waiting for a bank or another originator to bring that transaction to us, it's likely that they would be looking to sell the transaction to us for a lower amount. And so by the time it gets to the end investor, that investor may be coming in at par and not receiving any of the benefit of the upfront fee that would be otherwise charged and becoming revenue to investors. Credit analysis is obviously central in terms of our activities, so it's a very different in terms of no reliance on external credit ratings or reliance on an S&P or a Moody's rating for our assessment. Our team obviously do detailed, thorough due diligence in relation to the company to really understand what are the key cash flow drivers of the business's activities. So we do that so that we can structure terms and conditions to mitigate risk of loss. Obviously, through portfolio risk management is a key component in terms of the ongoing portfolio risk. I think I heard the prior speaker say that often a hold to maturity investor just invests to generate the yield and hopes for good luck, or hopes that the activity generates an acceptable level of risk. Certainly from our perspective, there's no element of hope. It's very much an ongoing involvement in direct discussions and negotiations with Australian companies and management to ensure that we remain across the detail. And particularly in an environment that we've just gone through over the last several months with the pandemic, it's been very important to make sure that you've got direct dialogue with management, can understand exactly what's going on inside the company, in the industry that they operate in, to ensure that the risk associated with continuing to provide finance to that company remains with equity. So I think what we've put here is just a couple of diagrams or charts there in terms of what we do and don't like in the current market environment. One thing that we've been challenged on a bit over the period of time is this perception that lending for property-related activity is high risk. And I guess our view is it doesn't need to be if the transaction is appropriately structured. So a lot of managers talk about, in other asset classes and the like, talk about their ability to preserve investor capital. I think in our asset class, the preservation of capital strategies that we implement day one are very clear. So when we sit down and negotiate a transaction with a borrower, we set the terms, we set the conditions, we negotiate the appropriate controls and covenants that the borrower will have to adhere to. We take appropriate reporting obligations or impose appropriate reporting obligations on those companies, taking security to mitigate risk of loss. And obviously what you're looking to do as a lender is to ensure that the risk associated with providing that financing rests with equity. So obviously investors invest in the equity asset class to generate capital gain and growth in earnings over time, which provides for a gain in terms of the capital value. They invest in the debt part of the capital structure to have lower risk and less volatility in terms of the capital, expecting that equity wears that risk of first loss. And so from our perspective, when we look at a range of transactions in the property-related market, we obviously are mindful that, property asset prices can fall. And as a result of that, you need to ensure that the lending that you're providing or the debt that you're providing to the borrower can sustain that level of downside risk. And so when I look at the bank sensitivities that they put out in the market, saying of a 30 or 35% decline in property valuations and how that would be considered a severe stress test for the banks, that's the kind of stress test that we undertake at the time that we provide the financing. And that's why you'll set a loan to valuation ratio, say if it's a senior facility, at sort of 50 to 65%. Expecting that 35 to 50% of the capital structure is at risk to equity that can sustain a sharp fall or deterioration in property prices. We also put up here on this chart something that we don't like, and it's kind of been borne out in the current pandemic environment. We had a number of opportunities over the years to provide financing to a range of student accommodation project financings. We always took the view that those particular financings were higher risk and not acceptable for us to lend to those projects or invest our investors' capital in those structures. And that's largely to do with two things. One, we could never be comfortable with the debt service capacity of the company. So effectively, you're relying on the demand from foreign students to come to the Australian market to go to an Australian university, things that are outside of the control of your borrower. And so the borrower is financing a student accommodation project. It's very difficult for them to be able to influence the terms or the standard of education product that's produced. And so the reliance on foreign students to occupy and have no ability to influence the product that's being provided to those was always of concern to us. Obviously, you've got a lot of risk around currency movements and the attractiveness of the Australian education sector as being a driver on cash flows that couldn't service the debt. But equally, when we couldn't get comfortable with the income or the debt service capacity, we equally were not comfortable with a range of ways in which we could exit the exposure if the credit quality was to deteriorate. And by that I mean, when we look to lend, we want to make sure that the company can service and repay its debt, and that we've got alternatives if there is a deterioration in debt service capacity to ensure that our investors' capital isn't at risk. And that's usually in the form of security that you take. Unfortunately, in this part of the market, the ability to enforce your security only allows you to enforce and take control of student accommodation. You can't change the zoning easily, which would allow you to exit by way of selling them as residential apartments. So the way in which we would get our money back was also less attractive to us. So we weren't convinced on the debt service side, nor were we convinced in relation to exit scenarios and the way in which we would exit. So this is an example of the analysis and work that we do and the views that we form. And obviously through this period of time, going back through March, the start of the sort of shutdown period in the Australian market, there are a range of industries and sectors that we have avoided because we couldn't be comfortable with the debt service capacity of the company, nor could we be comfortable with the way in which our investors' capital was protected and preserved and we could retain value. And so things like the tourism sector, where you've got larger levels of volatility in earnings, we've stayed away from. Aviation, again, volatile sector, heavily geared. Again, that's an acceptable risk for equity, but for us as a lender, we sort of saw this as being an unacceptable risk. Education, student education sector, hotel REITs or property REITs, retail property trusts and the like, we've stayed away from those sectors again. Exposed to discretionary consumer spending, which we felt was a situation that would see us have an unacceptable risk in relation to the debt service capacity of the companies that we lent to. So I think in terms of the market that we operate in, it is a private market. I actually really think that's of benefit to investors. The market is a little bit opaque. Borrowers don't have a means to determine what is the pricing that's available to them. It's an inefficient market. And so as a result of that, investors are requiring us as the manager to ensure that we negotiate the right terms and conditions to mitigate risk. And we also have the ability to negotiate the right terms and pricing to drive a benefit to our investors from that inefficiency. And so when I look at our market, the preservation of capital is obviously central to what we do. And we do that through appropriate covenants and controls and security. And those covenants are always focused on debt service, the capacity to monitor and ensure that the company is generating sufficient cash to service and repay its debt. And equally on the control side, not seeing a deterioration in the balance sheet or the greater levels of leverage that might build up in relation to the company. So you're controlling those aspects to ensure that you're protected. One of the things that is quite interesting is that the Australian market has actually benefited over many years. A lot of the information that you see put out into the public market in relation to loss rates and the like is US data. The Australian market does benefit from what we think is the most favourable terms or favourable legal and corporate insolvency framework in the world. The protections that are afforded to you as a secured lender are actually key ways in which you mitigate downside risk of loss. And we've seen over many years, so this chart here goes back to 2009, when the banks were first required to report this data, that the level of actual net write-offs and losses incurred by banks through the period from the GFC to date, from lending to Australian companies, was 0.67 of 1%. So a very low loss rate. And certainly in our experience at Metrics, we've been operating our funds now for well over 7 years. We've consistently delivered for investors month in, month out. We've not exposed our investors' capital to the risk of loss in terms of exposing any write-offs. And today, I'm pleased to say that we still have our portfolio where we have no borrowers in arrears in interest or principal payments, and we don't have any defaulted securities. Obviously, this is a key component in terms of understanding risk. As I mentioned before, investors invest in the equity part of the capital structure to benefit from growth in earnings and value uplift. And where they are investing in the debt part of the capital structure, the debt needs to be structured in size to be able to accommodate downside risk. And so when we structure a loan facility for a company, we're looking to understand what is the level of historical earnings, what are the peak to trough cycle earnings, what is the likelihood that an event could occur that could see earnings deteriorate or revenue deteriorate, which would actually expose our position to potential downside risk of loss. So as a lender, you obviously want the equity capital within your loan facility to be the absorber of risk. And so to the extent there is a shock or a downside deterioration, then that risk of loss needs to be borne by equity. So if a company, say, being bought for, say, 10 times EV to EBITDA multiples, and as a lender, you might be coming in and saying, I'm prepared to lend 3 times. So effectively 7 times earnings as your equity buffer before your risk of debt position. So that allows you to be able to trade through market cycles without having exposure of your debt position to potential risk of loss. And I think the other thing that is important to understand is that as an unregulated non-bank lender, we're not in a position where we would be a forced seller. And so there are a range of ways in which we can restructure the capital structure to ensure that our investors' capital is preserved. We want to preserve value, and even if we did have a default or we did have a potential breach of a covenant, our activities would be designed to restructure the capital of the company, to put it on a more secure, stable footing, and then hopefully potentially provide our investors with benefit in terms of upside capital gains over time as earnings start to recover for that company. The interesting thing, I think, though, and it's really the investor's dilemma at the moment, is where do you go for income and capital stability? I've explained, I hope, some of the reasons why our market and our lending activities provide investors with comfort around capital preservation and the security or stability of the capital that's invested in our funds as we lend that money to companies, and the protections that are afforded through appropriately negotiated structures, terms, conditions, security and the like. But equally, we look at our market and say it's an attractive source of income for investors. And so obviously investors have seen now, as a result of this situation, the RBA cutting rates, so official cash rates have been cut. Term deposit rates, the banks are awash with cash as a result of investors' flight to stability and security and putting money more into deposits. And certainly, companies have had to respond to difficult trading environments by looking to preserve and retain as much cash within their businesses as they can. And as a result of that, the returns are not there for investors in the form of dividends that can be distributed. So importantly, when we lend to a company, it's the fee income that can be charged to the company together with the base rate and the margin for the risk that becomes the income. Less any expenses of the fund is then the operating income that can be distributed to our investors. And so when we look at our asset class, we obviously think they are attractive income generating assets. You're not lending money to get a capital gain. When you lend $1 to a company, you want to receive the fees and the interest payments on that dollar and receive your principal amount on maturity. It doesn't provide for a capital gain. The borrower is still obligated to pay you. Unlike equity, though, where the value of the asset is subjective, there's no subjectivity in a loan. The issue is the borrower has a contractual obligation to make the interest and principal payments on the dates that are due, and that's their obligation to you as a lender. And obviously a big component of our risk management process is to ensure that we maintain very tight control of our borrowers' obligations to meet their monetary payments to us, and we ensure that those payments are made on their due date and monitor that risk. Obviously, the portfolios that we invest in are well diversified, and that's an important feature in terms of lowering investors' risk. So from an investor's risk perspective, one of the biggest risks that an investor is exposed to is the risk of credit loss. And so all of our activities are designed to ensure that we originate good quality transactions with companies, that we appropriately structure the terms and conditions to mitigate that risk of loss, but then negotiate on behalf of our investors the right fees and margins that should be charged to those companies, reflecting the risk of providing that funding. I think one thing that is important to understand about the income sources that we're able to generate, it's not necessarily about just generating a yield and taking on more risk. We operate in what is effectively an inefficient, immature debt market in Australia. Most Australian companies are unrated. Most Australian companies are heavily reliant on the banks for funding. And as a result of that, and given the dynamics of our market, liquidity often drives pricing. And so when you see an inflow of foreign banks and lenders that are active, chasing particular assets, so at the moment you would say that the banks have got a regulatory benefit in terms of putting on more risk associated with higher investment grade or project finance facilities. And as a result of that, there's more liquidity in that part of the market. For us, that represents a less attractive part of the market currently because of the liquidity. And so the ability of a borrower to raise debt financing at attractive rates from a bank because there's greater levels of liquidity often will impact the price. Where we see pockets of illiquidity, they're the opportunities for us and our investors. So we've seen over the last number of years a gradual pullback from the banks in terms of their property-related lending activities. They saw material growth in their consumer home loan businesses, and as a result of that, they pulled back their lending appetite in terms of providing financing for a range of property-related activities. And that's opened up an opportunity for us and our investors to generate a higher return where we don't believe the risk is being reflected in terms of the returns that are being able to generate. We're actually generating a return because of the opaque, inefficient nature of our market that we operate in, and our team's ability to negotiate those arrangements with borrowers directly to secure better returns for our investors. So I think one of the things that's actually very important is obviously manager selection criteria. You know, there are a number of questions that come to us regularly at the moment about, this is a growing area of interest. There are a number of new managers that are coming to the Australian market that are looking to establish private debt businesses. And I think one of the things that I think is very important is to be clear on what is it that the investor's being offered in terms of the skill set and the credibility of the people that are associated with their product. And certainly from our perspective, we have a long track record now going back, as I said, well in excess of 7 years since leaving the employment of the banks. And so myself and my other partners have between 30 to 40 years of banking and finance experience doing exactly what we now do as part of Metrics Credit Partners. And so over the last 7 years, we've continued to originate transactions, to negotiate those transactions with borrowers, to mitigate downside risk of loss, but negotiating those transactions to drive the right return outcome for our investors. And so that origination capability, together with demonstrated track record, is seen in our fund's historical performance in terms of the returns that we've been able to generate for investors, the stability of capital, and the way in which we've preserved and protected our investors' capital. And that risk management component is a big piece to it. And so that comes down to team size and having appropriately trained and well-resourced team that have the skill set to be able to originate transactions and to manage the risk associated with lending to those companies. And so in our business, as I said, we have probably close on 60 people in 3 different offices, and that's not for any other reason other than we're seeking to originate good quality opportunities for our investors and seeking to build those opportunities to drive the right outcome in terms of both risk and return for our investors. As we've grown in size and scale, there are a number of benefits that pass through to investors as a result of that size and scale. Enhancements in terms of the liquidity that is available to investors as we've got greater levels of portfolio churn as our funds under management have grown. And so whilst we operate in what is often seen as a very illiquid asset class, we've been able to do a range of things through the ways in which our portfolios have been constructed and the way in which our funds have been designed to enhance the liquidity options that are available to investors. We could never have done that when we were a startup manager 7 or 8 years ago, but as our funds have grown and we've got a range of different funds, we're able to pass through the benefits of our size and scale to our investors. And we've done that in the form of costings, lower costings, better returns, better economics in terms of better origination opportunities, but equally there are enhancements available to investors as a result of the size and scale through enhanced liquidity of the terms of our various funds. And so appropriate fund terms are very important to us. We've sought to structure a range of different funds that provide investors with appropriate terms for an investor to have options and choice in terms of what is the risk tolerance of that investor, what is the return that the investor is seeking to achieve, and then what are the liquidity options of the fund given the asset class that we operate in. And that really reflects the fact that our market does span from very high investment grade through to sub-investment grade, and along that risk continuum there are opportunities to generate attractive returns and to have appropriately well-structured facilities. So we have a number of funds that are available to self-managed super fund and retail clients. We have a number of funds that are for wholesale and institutional investors only. But the three funds that we have here are two ASX listed vehicles, the MCP Master Income Trust and the MCP Income Opportunities Trust. We were the first manager to bring listed credit to the ASX back in October of 2017. And since listing of those funds, we've exceeded the minimum target returns for our investors since listing, and we've continued to diversify the portfolio holdings and lower the cost structure for investors. And that's what we will continue to seek to do for our investors. With the MCP, or the Metrics Direct Income Fund, MDIF, that's a fund that was launched at the beginning of July, very similar to MXT. So where do these funds sit for investors in terms of their portfolio construction? MXT, the MCP Master Income Trust, we see as more of a defensive alternative fixed income product where an investor has a choice beyond traditional bonds, hybrids, term deposits and others to generate an acceptable return. So that fund seeks to deliver to an investor the RBA cash rate plus 3.25 net with income paid monthly. And since inception, that fund has outperformed that. But one of the risks that an investor is exposed to with the MCP Master Income Trust is the traded price on the exchange. And so we realise there are a number of investors that value daily liquidity and want the ability to buy and sell on the stock exchange. There are other investors that want to have the ability to not have to have that risk associated with traded values. And so as a result of that, the Metrics Direct Income Fund was launched in July of this year to provide investors with that choice. The MCP Income Opportunities Fund was designed to provide investors with an equity-like income. So in a situation as we've experienced now, where companies are cutting dividends, equity prices have been very volatile, it was our position that we believed that we could provide investors with an equity-like income, but a lower portfolio risk in terms of investing in the debt part of the capital structure as opposed to equity. So less volatility in terms of asset values, but an attractive income. And so that fund seeks to deliver investors 7% per annum with income again paid monthly. And since April of 2019, when that fund was launched, we've exceeded that target return. And that fund is also designed to provide investors with some capital gain opportunities. This is the historical performance. You'll see there with the sawtooth diagram on below, recognising that the fact that the stability of the asset class provides for an attractive capital preservation strategy for investors and regular predictable income. And so we pay income on all of our funds on a monthly basis, designed to ensure that investors are getting the benefit of the regular income through interest and fees that are paid by borrowers that can be distributed immediately to our investors. We distribute that through on a monthly basis. Importantly, as our funds have grown, we've sought to continue to diversify exposures through managing credit risk by lowering the exposure we have to any one individual borrower. And as a result of that, our portfolios continue to be well diversified and providing an attractive alternative source of income for investors. So when I look at what is the usual traditional view of the world in terms of, we're often told that deposits, bonds and others are low returning, low risk, and equities and others provide a material higher return, but investors are exposed to greater levels of risk. What I hope to show in this particular chart is the fact that, when we look at the performance of our various funds, not only have we delivered investors with an attractive source of income, but we've also done that in a way that doesn't expose our investors to increased volatility of capital values. So again, we'd like to challenge the assumption that the only way to generate income and returns in credit or fixed income is by taking more and more risk. Our view is private market activities with appropriately structured terms and conditions, lending money to Australian companies is a means to mitigate downside risk of loss. and people are backing us and our team at Metrics to be able to negotiate and drive the right return for our investors' capital in terms of the negotiation we have with companies when we're seeking to set terms, conditions and pricing of those facilities. So again, they're the key drivers in terms of the way in which we seek to manage risk and drive the return for investors. So I look forward to talking to you later in terms of the Q&A panel, and back to you, Matt. Thank you.
Thanks, Andrew. We're running slightly ahead of time, so Andrew, I'm going to spring this on you. We've had quite a lot of questions from our audience. So I do have a question here without notice, if you don't mind. It's from Bruce Lanyon. He says, Andrew, can you please talk about how you handle loans that go bad and whether you can syndicate those out?
Yeah, I think our view is always to look at, first and foremost, ensuring that the company you lend to doesn't have a poor business model. And so what you want as a lender, what you want is to first and foremost understand the nature of the company's activities to ensure they've got sufficient diversification of business and cash flows and that their business model can be sustainable. And so one of the risks that obviously present in periods like this is the risk of structural change. And so our concern is the longer shutdown and lockdown and disruptions occur to the economy, that there may be some fundamental change in terms of the consumer or business relationship that may see a structural change. And so, the risk around structural change has been one of the reasons why we've never been a provider of funding to the media sector. Our view was that was a sector that was experiencing substantial structural change, and as a result of that, we didn't lend to that sector. The retail property trusts, again, our view was we were concerned around the consumer discretionary aspect, but also the structural changes flowing from online retail. And as a result of that, we've taken negative views on those two particular industries as examples. And so if the risk around structural change is something that needs to be considered up front. So if a company then finds itself in a position where earnings deteriorate and they've got an inappropriate capital structure, then I guess the position here is, as a lender, you need to be able to ensure that your rights are protected and you're controlling your position. And so that may well result in complete loss to existing shareholders and equity. So often a lender would usually use a couple of tools initially in an environment where, if credit quality was deteriorating, how are you going to manage the risk? The first thing is you'll say to the company, you'll need to inject additional equity. If the shareholders are not willing to inject additional equity to lower the debt, then it will generally be a position where a lender will require an asset sale program. And so the company would then be forced into a position to sell assets using those proceeds of sale to de-lever and pay back lenders. If a company fails to raise equity, restructure, sell assets, and the risk is still unacceptable to a lender, then a lender may end up getting into a position where they trigger a default and they crystallise and enforce on their securities. And so from our perspective, as a lender, you want to make sure that you manage that process and control the outcome. And so as a non-bank lender, we don't have the same risk that a bank does, in that they often become forced sellers because they're highly levered and they're regulated. As a result of they're required to hold more and more capital against an asset if credit quality was to deteriorate. So for us, our driver and our concern is to ensure that our investors' capital is preserved. And that may mean that equity value goes to zero, but it doesn't mean that your debt value is lost. So if you think of an example, say the company's worth $100 million and you've lent 50, the company's enterprise value deteriorates down to $50 million. 50 million of equity can be lost. That 50 million of debt just needs to be restructured but preserves value for investors.
Well, thanks, Andrew. That's a very comprehensive answer, as usual. Well, look, now you've heard from two managers with very different approaches to fixed income investing. Coolabah, an active trader of highly liquid, investment-grade fixed income securities to generate alpha, and Metrics, an originator and manager of private debt. Now let's bring it all together, and I'd like to introduce Ron Mehmet from Lonsec to moderate Q&A. Ron joined Lonsec in April 2020, and he brings extensive experience in manager research, funds management and portfolio construction from previous senior roles at BT Financial Group and ING Optimix as part of the multi-manager team, and more recently at Perpetual. In just a few minutes, Ron will moderate questions for our panellists. Before we do that, I'd just like to remind everyone to remember to click the CPD Hour link. That will enable you to get your CPD points very quickly and easily with our CPD partner Portfolio Construction Forum. Also complete the survey on your screen so that we can ensure the best experience for you in the future. Speaking of the Portfolio Construction Forum, we do have some limited tickets available, complimentary, from Pinnacle for the forthcoming Strategies Conference on the 30th of September and the 1st of October. So if you'd like one of those, please let us know quickly. Also, if you'd like to view this session on demand or sessions from earlier in the week, simply click on the link that brought you to this meeting today. Before I hand over to Ron, I'd like to say thanks for tuning in, and we hope you've enjoyed the Pinnacle 2020 Virtual Summit. I hope you have a good day. In just a few minutes, we'll start the Q&A with Ron.
Thank you very much, Matt. And today we're going to do a Q&A about the strategies in public and private debts. And I've got Chris now and Andrew with me along for the Q&A panel. Just to give you a bit of a background on this, what we're going to talk about is just pretty much on the strategy side. And it helps a lot of you guys and girls out there that are putting strategies together for your clients on the income side and also a bit on the growth side, particularly when you have private pensions and you've got to provide monthly income for those pensions for whether it's retirees and also your accumulators out there. First thing I want to show is a slide that we've got some considerations and trends to consider on the public and private debt strategy side. Talk a little bit about liquidity. We're going to discuss a little bit about income and growth. Also a bit about secured and unsecured debt, and also a little bit about the capital structure and recovery values. Now, the guys have mentioned a bit about each of these topics, and we're going to discuss them a little bit further from their presentations. The reason we're bringing a lot of this up is taken in the context of the markets that we're in now. Australia's back in recession, which we haven't seen since 1991. We've got Australia's version of quantitative easing that's happening. And we've also got, for the first time, as the guy said, bank bill rates are down at 11 basis points. Now, I remember the last recession that we had a very long time ago, as we said, in 1991. And the period before that, I used to work in the money market. We had an RBA cash rate then of 17.5%. The 90-day bank bill rate was 19.75 at that time. And we also had the 10-year bond rate at 15.5%. So to come from that period and that recession and to come to today's dynamics, it's extremely hard when you're looking at what strategies, when you're constructing a defensive portfolio for your clients and providing that income with some growth there. So the first question I want to come across to the guys is, which part of the debt market, given the dynamics these days in the market, are you looking at? Where can you try and add value? Chris?
Yeah, sure, Ron. We actually look across pretty much all sectors within the public debt market, so the tradable debt market. So right now we are buying and selling semi-government bonds. We're buying and selling secured senior bank covered bonds. We have been trading some bank senior paper. We've been investing in bank subordinated bonds and in hybrids. So the opportunity set for us really changes as a function of the mispricings we observe, and we're quite agnostic. As long as the assets don't have much inherent credit risk, and as long as they're liquid and tradable. Our portfolio, for example, in March, we held 2.24 billion of major bank senior paper and covered bonds. We basically hold none now, so we've taken profits on all of that paper. In March, we held no semi-government bonds. Today, we hold some semi-government bonds, and in March, we hold no Tier 2 subordinated bonds, but we bought $300 million of hybrids. So for us, it's about the opportunity set, where the mispricings are, and where we can get capital gains, not yield.
Just to also ask Chris on that side, how did you find the bid-ask spreads in the marketplace, and how do you attribute that in your performance?
Yes, that's a super interesting question. It's a little bit complicated for perhaps some folks, but so we bought and sold over $1 billion of bonds in March. And we, for a super fund recently, had to do an analysis that looked at our average bid-offer spread. And the bid-offer spread is just like a transaction cost, right? And in March, bid-offer spreads were incredibly wide. But it's super interesting, the liquidity in March. So, government bonds were liquid, bank senior paper was liquid. Interestingly, hybrids were liquid, but then other highly rated assets, like, for example, AAA rated, non-bank issued residential mortgage-backed securities, totally illiquid. Across our $1 billion plus worth of trades in March, we actually had a negative bid-offer spread, I think off the top of my head, of 0.11%. And that was because we were so active, we were actually basically buying below the price on the day and selling above the price on the day, which meant we actually had negative transaction costs, which means we added value through executing. But generally, if you weren't active and you held a liquid assets, it was diabolical. Illiquidity was manifest, and a lot of credit portfolios became frozen.
If I can bring Andrew into the discussion here. Andrew, just a little bit about where you're looking to invest going forward, and plus what happened with your loans during that March quarter. How did you talk to your clients? You mentioned a little bit of that in your presentation, quite regularly, and the process that you went through to just check on your whole portfolio and keep on top of things during that quarter.
Yep. I think our market is quite unique in that it's very much a bank-dominated market. And so you tend to have these sub-markets. And the 4 or 5 key areas where we're most active is in loans to publicly listed corporates. We provide financing for project and infrastructure-related borrowers, commercial real estate, both development and also for real estate investment trusts. So think about land subdivisions or residential high-rise and the like. We're also active in acquisition finance, which is providing debt facilities for companies to be acquired predominantly by private equity interests. Another area of interest to us is in structured credit. And so across that market, we're very active. We have teams of working with the investment committee and my partners around seeking to find opportunities to lend to companies. So we're always in the market looking to find good opportunities to build relationships with companies. We're looking to support good companies that have got good earnings and good stability of earnings and cash flows, where we believe that we can provide an important source of non-bank finance to those companies. So we're very active in that period. So I guess for us, through the period of March to date, obviously it's been an area of heightened risk. There have been a number of areas where companies' earnings and in fact their revenues have been materially impacted as a result of some of the decisions that the governments have made. But importantly for us as a team, you've got information rights and you've got relationships with those borrowers, and so the borrowers are dealing and providing you with private information. So we have detailed knowledge of the companies that we've lent to, their activities, what's going on in their business, how they're resolving their position. So we wanted to really understand, what was the earnings impact to companies, how management were going to respond in terms of cutting costs. We also wanted to make sure that the companies we lent to had sufficient liquidity to be able to trade through this period of time. And so how much cash have you got on balance sheet? How much committed undrawn funding is available to you? And how are you going to manage your cost structure and your earnings profile as you go through this period of time? Interestingly, though, I think people often say that recessionary environments must be an area of higher risk for a lender. I actually think it's the reverse. You get a situation where liquidity from banks dries up, and so they become less willing to take on risk, and so that withdrawal of liquidity actually creates an opportunity for those that have got capital and the skills to lend. And so what you actually tend to find is that terms and conditions actually move in the favour of a lender. They become more onerous, tighter. The pricing, because of the withdrawal of liquidity, pricing tends to move higher as well. And so you get this benefit in terms of lower risk profile, lower risk structures, better terms and conditions, and improved pricing.
Now, Chris mentioned about the buy-sell spreads and what happened in his marketplace. Being on the private debt market side, you mentioned earlier there was no defaults. Now, there was a number of stressed companies out there much broadly. How do you handle, when you talking to your companies, the pricing, the par value of those assets, and if anyone's stressed or needs restructuring?
It depends which vehicle our investors are invested in. Some of our funds are daily mark to market, where you're obviously subjected to ensuring that the fund is, or the assets are appropriately valued to market. And we do look at a range of different market comparables. But the real driver of valuation is really credit risk. And so if you've got a situation where a company's position was to deteriorate and it was likely to impair your debt, then that value would be the greatest risk of loss. If you actually look at our market, because it's a bank-dominated market, you actually had a situation where the RBA came out and announced the liquidity facility, all designed to ensure that volatility and dislocated markets, public market security prices, didn't actually translate in terms of adjustments to credit margins and spreads into the real economy. And so what you actually have is a situation where credit spreads in our market really didn't move in any material way in the way that they did in public market securities, where you've got more institutional liquidity being a driver of pricing. And so, you know, the real drivers of pricing in our market is tenor, credit quality, risk of loss. And so for us, that being across that on a daily basis is very important to be able to get an appropriate mark to market on the assets, but equally important to test the risk of impairment or credit loss.
Ron, I just add there that I think Lockhart's right. Like in our markets, we saw explosive increases in credit spreads. You know, hybrid spreads went from 270 over bank bills to 841 over bank bills.
Yep.
Major bank senior bond spreads went from circa 70 over bank bills to 175 over bank bills. Subordinated bond spreads went from 270 over bank bills to, 160 over bank bills to about 400 over bank bills. So there were huge dislocations, but that brought with it tremendous opportunities to buy assets at those wide spreads. And people have captured, in our portfolios, we've had individual assets that have delivered 15 to 25% returns because we bought them at 850 over and they're now trading at like 320 over.
Just on the point that Andrew made about the TFF facility, that the central banks come out and the banks can basically go there and borrow money at 25 basis points. Now that's got a major impact in both your markets. One is, why should a bank issue investment grade paper, whether overseas or here, at where the spreads used to be, 50, 75 basis points, and you've got a TFF of 25? What does that, we're going to ask Andrew, what does that mean on the bank loan side and the availability for you to pick banks and their bank loan portfolios? And what does it mean going forward for spreads, particularly if the banks can go at 25 when you've got, and it's causing the 90-day bank bill rate to be at 13 basis points, as your colleague mentioned earlier?
Yeah, so for us, this has been huge. You know, the Term Funding Facility is a $200 billion lending facility, and it is effectively disappearing the bank senior bond market. And that's a huge part of the credit market. So I think it's going to create a lot of problems because that is a hole in portfolios that will otherwise need to be filled. Having said that, it was an opportunity for us. So we, as I mentioned, held $2.25 billion of bank senior paper in March. And when the TFF came in, that crushed senior spreads. So we exited that paper, which was trading as wide as 175 over in March, at about 45 over in July. For us, it's also meant that, so it's an opportunity in senior bond markets. It's a problem for people who rely on senior paper as a key cornerstone in their portfolios. It has been an important part of our portfolio, but we see other opportunities. So, for example, at the same time, you've had explosive increases in government debt. So a big chunk of our portfolios right now is semi-government bonds. I own right now about 1.5 billion of state government bonds. And the interesting thing there is the states are paying much more to raise 3-year money than the banks are from the RBA via the TFF. So as you said, they pay 25 over, where the states will be paying about 35 over. And for their 10-year money, they're paying about 135 over, despite the fact that the states are basically government guaranteed and much more highly rated than the banks.
So your portfolios, from what they used to look like last year to what they look like this year, what's inside them and the construction of them sounds like it's going to be quite different, given what the central bank's doing.
Yeah, our portfolios are changing all the time because we're buying and selling typically 70 times a day, typically trading, $80 million a day. We've bought and sold $14 billion already in the first 8.5 months of this year. And so every month our portfolios are going to look different. But the dislocation right now for me is in semi-government bonds. They're trading on spreads that are way too wide, vis-a-vis where government bonds are and where senior bank bonds are.
Andrew, what does it mean for the major banks and their loans and where they're sourcing their money for those loans, and what ramifications has it got for yourself in the private lending area?
A big driver of our market pricing is liquidity and disruption that's occurred because of bank regulatory drivers. And so what you've actually got is at the moment is, you're right, banks' cost of funding is actually very low. They're awash with cash, deposit rates are next to zero as investors fled other asset classes and went to safety and went into cash. One of the interesting things though is that the banks are saying that their cost of funding is higher. And so the issue is it's a negotiation between a borrower and a lender, and I guess a skillful lender can extract an appropriate return and margin for that negotiation process. It's not a market clearing price. It comes down to every interaction you have with the company to be able to determine what is the appropriate price that you should charge for that risk. And what you actually find at the moment is that the banks are actually becoming more conservative. They're becoming less willing to take some risk. Transaction timeframes are slower, and so obviously that creates opportunities for us in terms of speed to market, the ability to move quickly with a borrower, and to appropriately take advantage of the illiquidity that is occurring when foreign banks in particular withdraw. And so we're doing something in our market at the moment where we've gone out to around 50 banks. And the common position from a lot of the foreign banks is, sorry, we're not doing any new to bank lending activity for the rest of this year. And that's been a consistent theme. So you can see there's a widespread withdrawal of market liquidity that pushes upward in terms of pricing power that a lender can then pass through and charge to a borrower.
Really? What type of sectors or companies are coming and knocking on your door if they've got difficulties with their banks and saying, will Metrics help us out with a bank loan and have a look at our books? Any particular industries or up or down the capital structure? What type of opportunities are coming across at an industry level for you?
Certainly not a lender of last resort, Ron. Yeah. So I think from that perspective, we don't have companies that are coming to us that can't get financing from a bank. We don't deal with SMEs and we don't deal in the consumer sector. So our borrowers are larger businesses and larger corporates that have a range of options that are available to them. But we continue in those 4 or 5 key markets: corporates, project financing, property-related lending activity, and acquisition financing. Interestingly, there's a number of transaction opportunities across each of those parts of the market that we're working on an ongoing basis. So we have a very strong deal pipeline. For us, it will take, I like the fact that Chris can buy and sell in a day, and for us it'll take us anywhere between a month to well in excess of 12 months to originate a deal, structure it, and then provide the funding. So it's a long-term process as you seek to understand what are the real risks associated with lending to those companies.
Yeah. What's happened with the workload for your staff? I know you mentioned before you've got nearly 60 staff now. What's the workload like managing your existing portfolio, looking at new applications? How time consuming has it become for your portfolios?
We've continued to resource the team as our funds under management have grown, but certainly through that period of late February through to April, May, we took a very sensible position, which was the market, business and economic conditions were very uncertain. And as a result of that, we weren't actively looking for new lending opportunities. Our position was you manage your existing portfolio and you wait until you've got a better sense in terms of the way in which this event was going to flow through in terms of companies' earnings and the like. And so from our perspective, just you take a step back, you wait and see, you monitor the performances of the existing companies you lend to see what is a trend that's occurring in terms of earnings profile and outlook in different industries and sectors that you have exposure to already. But certainly through that period of time, our team were heavily involved in meeting with borrowers and having Zoom calls regularly, going through the detail of up-to-date liquidity analysis on a regular basis. And so I always say to people that up until the end of February, credit ratings meant something. At the end of February on, it was liquidity risk analysis that was the central driver. We re-rated all of our portfolio based on a rating scale, determining how much liquidity and firepower those companies had to be able to trade through extended periods of dislocation and difficult market conditions.
Did you have to change any of the par values, even temporarily, during March, April?
Yep, that's a regular feature. So our portfolios in the mark-to-market part of the portfolio is valued on a daily basis. And that mark-to-market part of the portfolio is for those investors that are buying and selling or have the ability to redeem and get liquidity. But all of our processes are independently overseen by a large international accounting firm. That's done on a monthly basis. They test our assets for valuation and they test our portfolio for impairment risk. And then obviously we have a half-year process. So it was very important for us given we have two ASX listed funds, that when an investor buys units in the ASX listed fund, that they can have confidence that the quoted NAV is accurate and correct, and it reflects the carrying value of the portfolio, and that it reflects the risk of impairment.
Now, the same question I asked Chris before. When I look at your portfolio a year ago and I look at it now across your portfolios broadly, has there been any material changes in different sectors or parts of the capital structure within your portfolios, which you mentioned are pretty diversified?
Not really. What we do see is liquidity from our existing portfolio in terms of just the natural runoff and churn. And so it's interesting, like people sort of say, oh, how do you know your NAV is fair income? Well, we've been repaid on that facility. And so, in some of our funds, we've seen 30 to 40% of the portfolio between March and the end of July actually fully repay and provide us with capital that can be recycled into new transactions. But generally, the mix of our funding and structures is very consistent. We cover those 4 or 5 key parts of the market: corporates, project finance, property, acquisition finance and the like. And we find opportunities to lend to companies in those areas. And we continually seek to reduce our investors' risk by trying to diversify our portfolio by lowering the exposure you have to any one individual borrower.
Do you also have undrawn facilities?
Yep.
And that you get paid fees as well?
Yep. So obviously one of the attractions about our activities is the ability to not only provide funding on a term basis, but we needed to be able to compete with the banks. And so we compete and we work alongside the banks in terms of funding corporates. So that means you have to have the ability to do a revolver. You have to be able to have the ability to do a progressive construction facility. So a progressive drawdown construction facility, the ability to do CapEx lines, acquisition facilities and term debt in multi-currencies is an important aspect of our ability to compete against the banks.
A question to ask both of you, I'll come across to Chris, is given the term structure of where rates are, and in Australia, historically, we haven't seen them this low before, and given your investment process, tell me, how are you going to meet your objectives? Because a lot of wealth management firms out there have got these objectives that they might have set a few years ago when the term structure was much higher. You've come now to where they are, spreads are coming in. How hard is it going to be out there to continue to deliver what you've got in your PDS objectives, for example?
Yeah, that's a great question. And I think with the 10-year government bond yield, in or around 1% and the cash rate at 0.25, I think a lot of people are going to struggle, is the truth. Whether they're willing to admit that is obviously another question. I think we're somewhat fortunate because we don't drive our returns through yield. In the year to date, between roughly 50 and 70% of our total return has come from capital gain. So we have 25 guys, 12 analysts, 5 PMs. 4 of those guys have PhDs, 2 university medalists, and we have 30 to 40 internal quantitative bond valuation models that reprice every liquid and very safe bond globally to try and hunt out for mispricings where we can get price appreciation, irrespective of the yield, right? And that price appreciation or those capital gains, as I said, are driving up to 70% of our total return. And actually you get, as yields come down, the sensitivity of a bond's price to a change in credit spread increases. So you get something called positive convexity. So, one choice is you chase yield, and that's what I think most folks are going to be forced to do. So that'll be more loans, more high yield bonds, and more interest rate risk, liquidity risk, and credit risk. Another choice is to stay in really high grade liquid markets and hunt out capital gains. I think one thing that's also comforting for me, Ron, is when we look at on our sales, the share of the time we're generating capital gains. Since inception across 15,000 bond sales, it's been about 88% of the time, but since 2019, it's risen to 91% of the time. And in 2020, it's risen to 93% of the time. Wow. And so our hit rates are actually improving through time. So we think we're pretty confident that we're going to be able to exceed our objectives through alpha, not through beta.
Okay. And Andrew, a lot of people I hear out there have decided to go down the capital structure. They're going towards a lot more high yield, trying to keep their running yield up. But tell me, how do things look to you, given where the term structure is now and the objectives that you've got in your PDSs, and to meet that from an active basis in the private debt market?
Yeah, I think over time our market will continue to see banks reduce their exposures. So balance sheets will continue to shrink within the banks. Borrowers will be looking for alternative sources of funding. And so we're in a good position because, we built good long-term relationships with companies. We're not somebody that is a group that's going out there trying to take advantage of a company. We're not a group that's trying to, be a lender of last resort. We're trying to be and are a provider of capital to these companies to support them. And so from that perspective, having the ability to have good relationships, have good networks, have invested considerably in origination and direct origination capacity means that we're always in the market looking for opportunities. In fact, as our funds have grown in size and scale, the number of borrowers that are actually making reverse inquiries of us and looking for us to be involved in providing funding, as people are confident around the reputation and the way in which we work with our companies that we've lent to, that sort of just continues to be enhanced, and that's a positive for investors.
How much has your market grown in recent years, as you said, away from the banks to yourselves and your peers out there? How much more can that grow?
It's material, Ron. At the end of it, I think the banks collectively have well over $1 trillion of corporate debt on their balance sheets, and I guess we're at $5.5 billion, and so you can see there's a material growth opportunity if you believe that regulation and it's our view that the banks were no longer the natural holders of credit assets on their balance sheets, and that came from the GFC. So if you look at all of the regulatory impacts, it's about trying to ensure that the banks are safer, they've got more capital, they're lower risk, and part of that means that they don't want to necessarily hold large loans and corporate facilities on their balance sheet. But Australia doesn't have too many alternatives for borrowers to raise debt financing. So we still remain an immature, inefficient capital market in debt, and as a result of that, we're in a position to take advantage of that for our investors.
Now, I'm going to ask you a scenario now, which you both don't hold. We're going to talk about Virgin Airlines, both from a private and a public markets basis. Say theoretically, and you mentioned you had no defaults, everything's A-OK. Theoretically, if you had Virgin debt, can you explain to the audience what happens from the point of view of stress, restructuring, default, workout? How does it operate in the private debt markets? So people get a bit more understanding, because potentially we could be going through a rocky period in the next 12 months, and there could be some other ones like a equivalent of what's happened with Virgin out there. May or may not be, but just to give people a better understanding what happens in the private debt markets.
Yeah, well, it's an interesting example because you're looking at the number 2 competitor in a highly concentrated industry, highly leveraged industry. And then investors bought unsecured bonds. And so I guess the issue is investors perhaps were more willing to accept that risk than we would be. Certainly as a lender, if you're going to be in a position where you've got any element of subordination, you need to be in a position to be able to control that. And so if we're not either at the most senior part of the capital structure in a secured way, then we will ensure that we've got appropriate rights and protections that allow us to deal with the senior, and we negotiate those up front. And so, for instance, if there was a breach or an impact on the senior debt, you as a subordinated lender might want the ability to effect a change of control, or you as a lender might want the ability to inject cash to cure a senior default, or you might want the right to be able to buy out the senior or higher ranking debt. So there are a range of things that you would need to have negotiated up front. And unfortunately, in that particular case, you've got, the majority of the debt is against the assets, and so from our perspective, the price that was paid on that bond up front never reflected the risk, and it was a weak position for an investor to be in an unsecured bond in a highly levered entity, which has a lot of volatility in their earnings and the risks associated with it. But for us as a lender, deep workout corporate restructuring experience is very important. Our team have that, and we've had a demonstrated track record over 30, 40 years doing this and working through different events and environments. People sort of say, the market conditions have been benign, but there was a lot of volatility in commodity prices, for instance, in 2015. So as a lender, you have to be aware that these events occur regularly, and you need to ensure that equity wears that risk of loss, not you as a lender.
From our perspective, we actually sold 1.14 billion of bonds in January. We sold all of our corporate bonds. We only had a couple. We typically have government guaranteed businesses or too big to fail businesses that are oligopolies in our portfolio. Virgin in our analytics lab came up as a classic zombie. Over-levered, consistently unprofitable, senior unsecured, really subordinated debt, paying an 8% yield. We wouldn't have touched it with a 40-foot cattle prod. But actually so much so that we tried to get short the bonds in early March. So I'd actually borrowed Virgin bonds in early March, and we were looking to short them, I think in the first week of March.
Can you just give a little bit more detail on how that goes? Because a lot of people may not understand. They know shorting of stocks, but they may not have heard of shorting of bonds before. Yeah, so we through reverse repo, we borrowed Virgin bonds, and they were trading about 75 cents in the dollar at that time. And we borrowed a couple of lines and looked for a bid. And this is a classic case of, the public markets are very different to Lockheed's private markets, but in our markets, the NAVs were BS. That's why the LITs traded a huge discount to NAV. That's why the ETF, every fixed income ETF in the world traded a big discount to NAV, because no one believed the NAVs. And I should say, run an active ETF, HBRD, which did consistently trade at NAV all the way through March, because it held liquid assets. But with the Virgin securities on the screen, it was valued at 75 cents in the dollar. But I could not find a bid anywhere in the world at that point in time to buy that short, to buy that bond off us to allow us to get short. And when we modelled Virgin, similarly to Lockheed, we use top-down models that look at where every bond globally is trading, adjust for their characteristics, their term to maturity, their credit rating, their liquidity characteristics, where they sit in the capital stack, and we also have other models that look at the asset from a bottom-up basis, where we model the assets and liabilities of the business, we model their equity volatility, we model the probability of the bond going into default and the likely loss we'll incur. And that trade never made any sense whatsoever. And ask yourself this question, because it was sold, that was an ASX product that was sold to investors with commissions, I should say. And why would you have bought Virgin junk? Because it was rated junk. It had a B rating, or at least that part of the capital stack had a B rating. So why would you buy a Virgin junk bond in November last year when you could buy CBA equities paying the same yield, right? CBA is never going to blow up. Yeah, you'll get some equity volatility. CBA was down 25% in March, but that's a world of difference from being down 95%, which is what, unfortunately, the investors are facing today. So it's a very, very sad story. Coming back to our audience, looking at the fixed income side, constructing defensive portfolios, for their clients. Andrew, just give a bit of an insight on what are the benefits or what can add to that portfolio from having a allocation to private debt as a strategy across a defensive portfolio?
Yeah, look, I think it provides for stability of capital. And as I said before, there are genuine capital preservation strategies that are put in place day one when you lend. So have we, as the originator of that transaction, negotiated with the company the appropriate terms, conditions, set the right covenants, monitoring the risk in terms of appropriate ongoing reporting obligations, taken appropriate security? All of that's designed to mitigate downside risk of loss and ensuring that equity wears that risk. And then obviously the asset class provides for what we think is an attractive source of income. So the assets are not correlated with other asset classes. They are genuinely assets that are held to maturity where we're seeking to ensure that we're getting our fair return for our investors, both in fees and interest margins that are charged to companies that can be then provided to investors. So our asset class is very much one of large scale, seeking to deliver a consistent income, seeking to provide investors with stability of capital. And that obviously works very well in a defensive part of a portfolio. And obviously, if you're large in size and scalable, then the manager can obviously offer enhancements to investors in the form of liquidity options, cost structures that are more attractive. So I think from a manager's perspective, it's very important to manage your funds to ensure that that you're keeping your cost base under control, so that it's not impacting the returns to investors either.
Just on that, the clients that the audience has at times, some are conservative, some are more aggressive. How can they balance that out on the private debt side?
Look, we cover from very high investment grade through to sub-investment grade. So we have a range of different funds that cater to that. So I would always say that credit is not a homogenous asset class. As the originator of a deal, you can structure a deal to determine whether or not you're prepared to take more risk or less risk. And it really comes down to the nature of the industry and the borrower's position in that industry and the like. But you can equally say take on a higher risk position and charge appropriately. So say we were doing a mezzanine property transaction, that would be a higher yielding opportunity for an investor. And in that particular part of the market, we might sort of say, you might have a leverage of sort of 70 or 75% total leverage against the property. But because there's very few providers of that financing, we're able to charge probably 15 to 20% to the company. So that is an attractive return to an investor, where 30% plus of the capital structure of the borrower is at risk to equity, and you've got all the appropriate securities and controls to manage your risk. And so, I think a lot of people have, unfortunately in Australia, seen some very bad behaviour and performance from other fixed income managers. We've read today in today's paper about one that's gone through the process with ASIC in terms of Mayfair. Certainly from our perspective, it's about ensuring that you've got a reputable brand, delivering appropriate governance and controls around your investment activities to deliver a very professional and institutional quality product for investors. And that's what we're about.
Just quickly also, you mentioned about property and property investing. How much does that scare investors out there and ask you the question, how much property exposure or property development exposure you may or may not have in your portfolios when they see articles like that in the paper, and they worry about what's the outlook going to be on property investing going forward, and what have you got in your portfolios?
Yeah, I think there is a misunderstanding in the market generally. People worry about it in the context of equity. And so when you look at, say, some of the listed property trusts and you've seen material volatility in their valuations, that's an equity risk. As a lender, you shouldn't be taking that volatility and that equity risk. So if you're lending generally in a property trust, the leverage will be sub 50%. And if you're lending for a development purpose, you want to make sure that you've got the appropriate controls and structures where you're releasing funds on the basis of the project being completed. You've got appropriate contingencies, and you've got a known source of cash flow for repayment. And so that known source of cash flow should come from appropriate levels of pre-sales that can be able to be a source of repayment to repay your debt. But again, the risk should be borne by the sponsor or the equity provider in terms of capital at risk, but also, personal guarantees. And so the obligation isn't a non-recourse obligation on the part of a company. It extends to others individually. And
does that, on the property development side, is that like one of the clauses in a covenant that pre-sales and issues like that?
Yeah, every transaction is appropriately structured to ensure what is your source of cash flow and repayment. and then what's the risk to you. So you're generally looking to mitigate 3 or 4 key risks. One is market acceptance of the product. 2 is the ability to deliver the product in terms of the buildability. And then obviously another key risk is settlement default risk. And so from a lender's perspective, you're structuring the terms and conditions with the borrower to mitigate those key risks. So market acceptance is evidence of market acceptance is a number of apartments or land that have been sold to third parties at valuations. You get independent valuations. There's a lot of diligence that goes through that. It's not simply like, oh, you've got somebody that's building a development and there's a facility that has no terms or conditions or controls. They're very tightly structured and tightly controlled with independent oversight and regular risk reporting through the life of that project. So if the project's, say, a 24-month build, we will have appropriate contingencies for costs, contingencies for time built into the project budget, and we have independent third parties that verify those costings on a regular basis, and you only release the funding based on the progressive completion of the development.
Chris, on public markets, and tell us a little bit about the capital structure of that as well. We talked about senior debt of the banks before, you talked about state government, also bring into the equation the hybrid market.
Yeah, so we run 20 different strategies currently, or 20 different portfolios, and like Lockie, we have portfolios that target 1 to 2% over the RBA cash rate, all the way through to portfolios that target 11% over the RBA cash rate. But they all use the same alpha generating process where we're buying and selling all day, every day, trying to exploit those mispricings and trying to generate those capital gains, not yield. The asset class itself, actually also similar to Lockie, is about $1 trillion in size. So the total value of Aussie investment grade credit in Aussie dollars and in foreign currencies, so we'll trade in US dollars and euros, major bank bonds, for example, and hedge back to our currency, is about $1 trillion. However, the total value of all investment grade credit is about 23 trillion. Then we have access to a capital structure, and it's quite interesting. So you've got senior unsecured bonds, subordinated bonds, hybrids, and then obviously equity right at the bottom. Above the senior bonds, we have these things called secured covered bonds, and we trade the full spectrum. We actually have one client, a super fund, who we actually trade bank equity for as well, which is a little bit unusual and not something that we normally make a great deal of attention about. But currently, right now, we see in the opportunity set, mispricings, not so much in the senior market, that looks extremely expensive. In the covered bond market, so this week we've bought a Kiwi bank bond, AAA rated, backed by its assets, owned by the New Zealand government. Came at 70 over, it's probably trading around 65 over now, so instant capital gains. So we like the covered bond market. We don't like the RMBS and ABS markets. We've actually been a net seller of RMBS and ABS because we're expecting a huge increase in defaults next year when the 10% of Australian household borrowers who are currently on repayment holidays, those folks are not being classified as arrears or defaults in RMBS or ABS. So in March next year, that'll change, and the arrears stats are going to go through the roof. So we have very little to any exposure to that sector. The subordinated bond market has some value. It's still trading well wide of pre-COVID spread levels. And the hybrid market is very interesting. 5-year major bank hybrid spreads right now are trading at about 320 over bank bills. Pre-COVID, they're about 260. And in the post-GFC period, they've got to about 240. The banks have never been better capitalised or less levered, so the probability of being bailed in on a hybrid right now is very low, all things being equal. We price them on high PDs, so we assume that there's roughly a 10% probability of default or a chance of being bailed in. So there's a rich opportunity set in that segment. And then you overlay the semi-government bond market, which is another $300 billion market, where, as I said, you've got this weird situation where it's not only weird that the states, which are AAA and AA rated, have to pay more to raise money than the banks that are BBB rated in the case of an ME bank or a Bendigo or a BOQ, but you've also got this completely crazy situation where New South Wales, the biggest state, the highest rated state, issuing through something called TCOL, it's got the highest cost of capital. So New South Wales today pays more to raise money than Queensland or Victoria or Western Australia, right? So we see that as a mispricing. So that's why we've loaded up on $1.5 billion of mainly New South Wales government bonds in the last month or so.
I just want to come quickly back across to Andrew. Your thoughts on the RMBS market and the housing market, given the thoughts of what Chris just said.
I think the consumer market is quite difficult, right? Because you're facing in a situation of unemployment. We haven't had that for a long time. Up until yesterday, I would have said rising unemployment. It was a bit of a shock to us that number was lower. I guess the position is RMBS it's a structured credit product. It's not genuinely a loan. The loans are obviously the originator that's actually originated the loans to the individual consumers and then packaged those up. I don't think investors really have the ability, and we've seen it in offshore markets, to really understand the rated nature of those instruments and the attachment points. And so I tend to agree with Chris. They're a much higher risk investment than people perhaps accept in the Australian market. Certainly the Australian market has good protections for a lender and good obligations on the borrower in terms of repayment. But obviously if we go through periods of declining immigration, reducing, or increasing levels of unemployment, recessionary environments, then it's obviously going to be a position where consumers are going to be stressed, and that does flow through in terms of the housing market. But I don't think. I think the interesting thing is I don't think at this point in time I don't think anyone can really point to any evidence of overbuilding, and so we don't have the speculative building that has gone on in other markets. And so if you come back to my position as a lender, we want to lend against a known source of cash flow and repayment. That requires pre-sales. And so given the lending standards that requires pre-sales to demonstrate serviceability and cash flow, you don't get this excessive speculative building that's occurred in other parts of the world where you've had, if you think about Ireland or you think about the US pre-GFC, there's a lot of speculative building that was going on in those markets, and that created a lot of volatility in the asset price.
Ron, can I add to that?
We've just got a minute left.
Yeah, sure. Just quickly, I'd say on RMBS, I think the risk there is a lot of this stuff is very highly rated, but it also has very high yields. So if you buy Latrobe or Pepper or Bluestone or Liberty or First Mac RMBS, it pays at an attractive yield. But you need to understand that's for a reason. It's carrying risk. The main risk is illiquidity. And if you're ever if you were trying to sell those assets in March, you would have taken huge losses. I think overall on the housing market, I'm actually pretty constructive. We've had a view since March that national house prices will only fall by between 0 and 5%. They're off 2.7%. And our view is that the market will bottom around the final quarter of this year, following which we'll get 10 to 20% capital gains. Now, CBA has basically dropped their calls for 10% house price falls and more or less come into line with us last week. Westpac did the same thing yesterday. So they've slashed their forecasts now to only a 5% house price fall, and they're forecasting 15% capital gains.
Okay. Well, we've run out of time. Thank you very much to Chris and Andrew for today, and that pretty much wraps up things for the Pinnacle Virtual Summit. So hopefully you got something out of that, and it helps you with your portfolios, that when you are constructing defensive portfolios, traditionally looking at credit and looking at the fixed income, there's two other sources here that are offered by Chris and Andrew that you might consider when you're constructing a portfolio to provide income for your clients. So thank you again. Bye.